I only learned what I'm about to tell you after shadowing financial advisors. And after becoming a professional myself, I can better answer the question, which is best, a traditional IRA or a Roth IRA? But first, I need to explain what an IRA even is. You should know that IRA, the initialism, or IRA, the acronym, and yes, they're the same, you can say it any way that you want, stands for Individual Retirement Account. The traditional IRA was invented by the government in 1974. Congress made the Employee Retirement Income Security Act. Everyone in the professional world seems to just call it ERISA. And that's where the traditional IRA comes from. It has a handful of rules that can help you build a retirement if you use it right. And in 1997, the Roth IRA was introduced through the Taxpayer Relief Act, and it has its own rules. So there are two different accounts with two different sets of rules. You can have both open at the same time, and you can contribute to both, but they share the same limit. In 2026, that limit is $7,500 if you're under 50 years old, or $8,600 if you're 50 or older. And you can't contribute more than you've earned in any given year. If you're only reporting $5K of earned income, you can't contribute more than $5K to your IRAs. So let's say you're a 30-year-old. You can max out your IRAs this year by putting $7,500 in. That could be split any way you like. For example, $3,500 into the traditional and $4,000 into the Roth or anything else, so long as the total contribution into both accounts does not exceed the $7,500 limit. But why use an IRA at all if you can just have a normal brokerage account? And side note, but next week's video will be about opening a brokerage account versus opening a bank account, whether it's checking, savings, or high yield savings. And it's a much simpler video than this one, and it provides a ton of practical value that you might not expect. So subscribe to see that, and back to this video. So why use an IRA over a normal brokerage account? Because an IRA has some special rules that can help you pay less tax on your money depending on your situation. For a normal brokerage account, when you buy an investment in a stock, an ETF, a mutual fund, a bond, or whatever it is, if your investment goes up and then you sell, you will owe capital gains tax. If you held the investment for 1 year or less and then sold, it's short-term capital gains. And if you held for more than a year and then sold, you'll owe long-term capital gains. These are the two holding periods for capital gains taxes, short-term and long-term. And the timer starts the day after you buy an investment and ends the day that you sell. Next thing to know is that the short-term and long-term capital gains are taxed differently. Short-term capital gains are added to your same ordinary income tax brackets, but long-term gets its own advantaged tax brackets, helping you pay less in taxes. But in an IRA, you don't pay capital gains taxes at all. Taxes work completely differently inside one of those accounts. This is why you'll hear people call an IRA a bucket or an envelope or an investment vehicle. They're trying to say it has its own tax rules. The investments themselves still basically work the same, but the rules around how your money gets taxed changes, and there are other specific benefits and guidelines as well. The question is, when would you choose a traditional IRA or a Roth IRA or a normal brokerage account? And to teach this, I'll explain how each IRA works, and I made a PDF you can download in the description below because there's more than a few moving parts here. I'm simplifying these IRAs just a bit in this video, but the PDF lays everything out more fully. It's free, and I tried to make it as helpful as I could. Rule number one of the traditional IRA, it's tax deductible, meaning that this year when you put money into it, every dollar you put in lowers your taxable income. So if your taxable income was $60,000 and you contributed $5,000 to a traditional IRA, it lowers your taxable income dollar for dollar, and now you only have to pay taxes on $55,000. That is an immediate benefit. The second rule is related to the first. If you earn a nice upper class income, you can still contribute to your traditional IRA, but you lose the ability to get a tax deduction. And if you have a retirement plan through your work, you could have just a normal middle class income and still lose the tax deduction. So basically, your ability to get a tax deduction is based on how much you earn. If you earn too much, you can't get it. And if you have another retirement account like a 401k or a 403b, it lowers the threshold of how much you can earn before you're not allowed to take the tax deduction anymore. The third rule is that all the money inside the traditional IRA grows tax deferred. This actually means that however your money grows inside that account, you won't have to pay capital gains taxes due to that growth. This is huge. It could grow for decades with you buying and selling investments, managing the account yourself, and you don't have to pay taxes until you pull the money out of that account. But every dollar that you pull out is taxed as ordinary income. No more capital gains, it's all ordinary income. Rule number 4 is that if you pull the money out before age 59 and a half, you not only pay income taxes on each dollar, but a 10% penalty is added. That is to say, if you're 59 and a half or older, you can pull out any amount penalty free, but of course you'll still have to pay income taxes on that. The 5th rule is that the traditional IRA has RMDs, and that stands for required minimum distributions. The government basically says, when you get old enough, we're gonna start forcing you to take a certain amount of your money out of your traditional IRA each year. This is a downside. There are calculators that you can use online to figure out what your RMD would be. This example is from a Schwab calculator showing that if you're born on January 1st, 1958, and your account balance was $100,000 at the end of last year, and your spouse is not your primary beneficiary, you'd have to start pulling out roughly 5% of your total account balance and pay taxes on that as ordinary income when you turn 73. And the 6th and final rule of a traditional IRA is that if you are married, filing jointly, a spouse who is not working can still contribute to their own IRA with the earned income from their working spouse. Whew, that's it. You now understand traditional IRAs better than most investors. And if not, go back through this, write it out for yourself on paper, and download the PDF, and you'll master the basics in no time. But now we go on to Roth IRAs, and they are much simpler. Rule number 1 of the Roth IRA is the opposite of the traditional IRA's first rule. A Roth is not tax deductible, meaning that when you put money in this year, you get no deduction and you don't lower your taxable income at all. You're contributing after-tax money you've already paid income taxes on. So if your taxable income is $60,000 and you put $5,000 into a Roth, your taxable income is still $60,000. No immediate benefits with the Roth. The second rule is that a Roth has income limits on whether you can contribute at all. As your income climbs into a certain range, your maximum allowed contribution starts to shrink. And above that range, it drops to 0. I'll put the exact numbers and the phase-out ranges in the PDF. But basically, high earners can't contribute to a Roth at all. But there's a difference between a contribution and a conversion, and I'll get to that in a minute. The third rule people love the Roth is the money grows tax-free. I've been told by many professionals in the industry that Congress has actually repeatedly tried to dampen the power of a Roth, like in 2016 when it was proposed that you could have no more than $5 million in a Roth, but that failed. And in 2021, it was proposed to cap a Roth at $20 million, which also didn't happen. And people fear that Congress might one day impose something else, like a required minimum distribution rule. But there's no guarantee that any of that will happen. That's probably the most important takeaway here. No guarantee. But the reason Congress does try to dampen the power of the Roth is because of guys like Peter Thiel. He turned a $1,700 Roth into a $5 billion account just through his investments. Naturally, that freaked a lot of people out and begged the question of whether that should be legal or not. And it is still legal. The fourth rule makes the Roth very flexible. You can withdraw your contributions, that is your principal, at any time, any age, with no taxes and no penalty. So $6K contributed annually for 10 years means you would have $60,000 that you could pull tax and penalty free if you so choose. The fifth rule is about pulling out your earnings, not your contributions, but the earnings on those contributions. And this gets a little detailed, so I put this in the PDF. But the short version is to get your earnings out tax-free and penalty-free, 2 things generally need to be true. You have to be 59 and a half or older, and your first contribution to a Roth IRA has to have happened more than 5 years ago. It could even be a different Roth account, maybe one you have at Fidelity and then you have this other one at Vanguard that you just opened. If you contributed to any of your Roth accounts over 5 years ago, then you're good. If you pull earnings out before meeting both of those conditions, you can owe an additional 10% penalty plus have to pay income tax. The sixth rule of a Roth IRA is that there are no minimum distribution requirements. You can keep that money in there for a lifetime. The government's not going to make you pull it out. And when you die, the Roth can go to your kid or directly to a grandkid tax-free. But because of the Secure Act from 2019, The kid or grandkid who inherited your Roth will have to empty it by the end of the 10th year following your death. Still really powerful since they don't pay any taxes on a single dollar that they got from you. The final rule of a Roth is that if you're married, filing jointly, it's just like the traditional. Your spouse that's not working can still contribute based on the working spouse's income. And that's the Roth. It's a favorite for a lot of people because of the tax-free growth and the fact that there are no RMDs. So why might somebody choose a normal brokerage account over an IRA? Is there even a scenario when someone would do that? The IRA really is a powerful tool, but if your income is so high that you A, can't contribute to a Roth IRA at all, and B, bars you from deducting taxes with a traditional IRA, well then it would seem like a brokerage account with long-term capital gains might become the best option. And maybe you should stop putting money into an IRA. But that's not the case because there's something called a backdoor Roth strategy. Earlier, when I was explaining the rules of the Roth IRA, I said that there was a difference between a contribution and a conversion. Here's what I mean. A contribution is the principal that you put in, the $7,500 limit you can contribute in your IRA. A conversion is your ability to move any amount of money from a 401k or from a traditional IRA into a Roth IRA at any time, penalty-free. The catch is that you do pay income tax on the amount converted that year, but then it's in the Roth where it can keep growing tax-free for the rest of your life. An investor might do a Roth conversion if they lost their job and they're looking at having a zero income year. That puts them in the 0% tax bracket, and they could fill up that tax bracket with a conversion and still pay nothing in taxes, which secures some money in their Roth. And this is one scenario where that money technically never gets taxed at all. But what's a backdoor Roth? It's a strategy with specific rules that will hopefully be the last complex thing that I explain in this video. Again, the PDF download in the description will help a lot with all of this. Earlier I said that high earners can't contribute to a Roth IRA, but they can contribute to a traditional IRA. And remember that they're a high income earner, so they don't get the tax deduction, meaning that the money they put into this traditional IRA is after-tax money, just like it would have been with a Roth. There's one rule here to do a backdoor Roth. You have to have a total of $0 in your pre-tax IRAs by December 31st. So the end of the year in which you do the conversion. That would mean $0 in your traditional SEP or simple IRAs. And a way to pull that off, if you do have money in those accounts, is by rolling your pre-tax IRA money into your current employer's 401k or 403b plan. Then the backdoor Roth is when you convert 100% of your traditional IRA contributions for that year into a Roth before you invested in anything. So every cash dollar you contributed gets converted, and congratulations, you've just basically contributed to your Roth through a backdoor. And I do really hate how complicated that is. Coming to the end of this video, there's a question to consider. Does an investor have a lower tax bracket in their peak working years or in retirement? Generally, the answer is during retirement. So a 40-year-old earning a lot might be in a 22% tax bracket or higher, but a 70-year-old might only be in a 0%, 10%, or 12% tax bracket because they're retired, they're not earning as much. And if that 70-year-old were to do a Roth conversion, they would have saved money on taxes throughout their lifetime. Assuming that they got a tax deduction by contributing to a traditional IRA in their 40s, that's the first win. And then 30 years later, they convert to a Roth and finally pay taxes on that money, but at a lower rate due to them being in a lower tax bracket, due to them being in retirement. That's another win. So if you want to calculate and decide for yourself whether to invest in a traditional IRA or a Roth IRA, here's how to do that. First, if you choose to contribute to a traditional IRA and you're not one of those high income earners, you'll want to calculate the dollar for dollar tax deduction that you'll immediately get this year. Then, let's assume you invest every dollar that you saved on taxes back into the market. You want to calculate the compounding return of those saved dollars once invested. You can use a tool like NerdWallet Compounding Interest Calculator for this. Third, consider the potential calculation of doing Roth conversions in retirement, paying taxes on that, but when you're in a lower tax bracket. And that gets a little theoretical because you don't know exactly what tax bracket you'll be in retirement, but you can do some guesswork and draw out some different scenarios for yourself. Fourth, add together the investment account from the saved tax dollars you invested long-term to the traditional IRA account. Fifth, you'll have to then subtract the taxes that you will pay later in life when you're pulling money with RMDs or doing Roth conversions, because that is a crucial last part to calculating your whole traditional IRA strategy. But if you choose to contribute to a Roth IRA, first, you would calculate the money that you lose to taxes today. Then you can use that same NerdWallet calculator to simulate a growth rate of your investments over a certain number of years. And that's it for the Roth. Everyone is different. You might be a fan of keeping things really simple. The strategies around a Roth is definitely simpler than optimizing a traditional IRA strategy over your lifetime. And there are other benefits, like being able to pull your principal out of your Roth at any time, or not having RMDs to worry about, or leaving it to your heir tax-free. But if you're a fan of optimization and you're not scared of really crunching all the numbers required to squeeze every dollar out of a traditional IRA strategy in life, and maybe you prefer and enjoy running an Excel sheet and laying it all out, then that is up to you to decide. Or you can hire a professional like me at Plan and Act to actually set up, monitor, and execute your strategy for you. Plus, professionals come with other benefits too, like dozens and dozens of other services that you get access to when hiring one of us. But the biggest takeaway here is your retirement path is yours to choose. And I hope this video could help give you some tools to make those decisions that you might not have had access to before. Subscribe, and I'll see you next week for a much simpler breakdown of brokerage accounts versus bank accounts. And there will be some tips there that cost you hardly anything in mental energy or time, but will keep a lot of money in your pocket over your lifetime. See you there.